Hi all, this is Eunice again. Welcome back to my channel. Today I want to share something very important that many buyers only realize after they already bought a unit. So, imagine buying a condo, right? Then after you found out that someone else bought a similar unit in the same project for 300k cheaper. Sounds impossible, right? So for those who may not know, developer actually has a pricing strategy from beginning. Today, I'm going to break down the real pricing strategy developer use so you'll be better understand why some buyer pay much lesser than others in the same development. And there are three key points that we need to understand: the break-even price, the pricing phases, and also the sales movement. If you understand these three things, you will start to see why price move the way they do. So let me start with the break-even price. So think of it this way. Before a developer even sells a single unit, they already have a minimum price in their mind. And here, let's go and take a look what are the costs and the expenses that will be incurred. And what are all these expenses include? So basically, it includes the land acquisition costs, construction costs, labor, financing costs, permit fees, marketing costs, and also including the fees where the developer needs to build out the show flat. So this forms the break-even price. So break-even price is basically the minimum price at which a developer needs to sell a property in order to cover all costs and expenses associated with the development. And why is the break-even price crucial? Because it tells us how flexible a developer can be. Because they rarely sell below the break-even price unless they are under pressure. So this becomes an important reference point for pricing risk. So once we know the break-even price, that's where we can estimate the launch price. Of course, different developers may have different appetite on the profit margin, but I would say anything within 15% to 20% at the launch time is considered pretty normal. And here's an example how we calculate the estimated selling price. So basically it's equivalent to break-even price plus the profit margin, in this case which is 15%. So if the break-even price is $2,000 PSF, after we factor in the 15% profit margin, right, the estimated selling price will be around 2,300 PSF. And now let me show you these two projects. Why one can move fast while the other are struggling to move. So for Hill at Holland, only 4 units were sold out of 319 units on the launch day, while for Forest Woods, 65% of the units were sold during the launch day. So Hill of Holland was subsequently relaunched in year 2021 with a lower pricing. Why? Let's take a look at the detail in the next slide. So at launch, the estimated break-even price was actually 2,158 PSF. After factoring a 15% profit margin, right, the estimated selling price will be somewhere around 2,481 per square feet. But during launch, units were priced at 2,700 to 2,900 per square feet. So the sales were basically slow. Eventually, the developer has to relaunch with a more attractive pricing around 2,400 to 2,500 PSF. And that's when the movement improved. And now, in contrast with Forest Woods at Serangoon, the break-even price for this project is actually 1,207 PSF. The estimated selling price after factoring a 15% profit margin is around 1,388 PSF. And during the launch time, right, it was actually launched somewhere in between 1,300 to 1,400 PSF range, and about 65% of the units were sold. It is actually showing a very healthy demand in this case. So what does this tell us? When pricing is close to break-even price and sales are healthy, the project is usually more stable. But if pricing is far above the break-even price and sales are weak, developers may eventually adjust the pricing downwards. Second concept, the pricing phases, and which is what we call the 3-phase pricing. I would like to break developer pricing into 3 phases: Phase 1, Phase 2, and Phase 3. So Phase 1 is usually where 60% of the units were sold. And this is also the launch phase where buyers usually get a better pricing, more choices. While Phase 2 is usually where we see there are quite a healthy takeout rate in the range of 60 to 90%, where developers start adjusting the prices gradually as certain stacks move faster than the others. And Phase 3, which is what we call the last phase, and this usually happens when the projects are having more than 90% of the sales. This is where the supply becomes very limited And developers can become much more aggressive with the pricing because only a few units are left. And to put this into context, right, let's use Treasure at Tampines as an example to illustrate the pricing from phase 1 to phase 3 over the time. And basically, Treasure at Tampines is a mega development with more than 2,200 units in the Tampines area. The break-even price for this project is 1166 PSF. And after factoring a 15% profit margin, the estimated selling price is around 1340 per square feet. Phase 1 is when the condo was first launched. And prices were more attractive because developers wanted to attract more buyers quickly and create a strong sales momentum. Buyers also had a more unit choices during this stage. And based on the transaction, right, you can even see some of the units were transacted as low as below the break-even price, which is 1092 per square feet. Phase 2 happened when more units started getting sold. As demand increased and fewer units were left, developers slowly raised out the prices in phase 2. So popular stacks and layouts started to moving up first. Phase 3 was when only limited units remained. Even though transaction volume was lower, but the price actually went up sharply. Because buyers had fewer choices left and developers know some buyers were still willing to pay more to enter the project. And let me show you a clear example over here in the Treasure at Tampines. A 3-bedroom unit with a high floor and unblocked view was sold at 1.332 million in phase 1. And subsequently, a higher level on the same stack at level 10 was transacted at 1.384 million, which is about 50k additional in year 2021. But eventually in phase 3, a similar unit type facing towards the PIE Expressway was transacted at around 1.851 million, which is 400 and 500k extra, and yet with a less favorable facing towards the highway. And next, the unit with the pool facing here, which is overlooking here, was transacted at 1.335 million in phase 1 in 2019. And thereafter in phase 2, the similar facing unit, which is a pool facing, was transacted at 1.41 million. However, when we approach the final phase, right, and this unit here, which is facing towards the bin center, was transacted at 1.637 million, which is 200 to 300k more than the above pool facing units. And this is pretty risky as the first 2 units with the better facings, right, can always sell at a lesser price than the unit facing towards the bin center because their entry price is lower. And this unit with bin center facing will face more challenges when it comes to the resale market in the future. And now let me show you another interesting example. Pasir Ris 8. Before launch day even started, the project had already collected more than 1,500 of checks of interest, but there were only 487 units available. So from the beginning, demand was already much stronger than the supply. Then the launch day came and buyers started rushing in. Units were moving extremely fast, and by the end of the first weekend, about 85% of the units were sold. But here's the part that many buyers didn't realize at that time. Price actually started from 1,400 PSF in the morning. However, as the developers saw stronger demand coming in throughout the day, the prices were revised upwards for 6 times within the same day. So some buyers who entered earlier paid significantly less than buyers who purchased later at the night for a very similar unit. So in fact, some 2-bedder units reportedly increased by close to 360,000 within hours. And what does this tell us? It shows how important it is to understand which pricing phase of a project is currently in. Because once strong demand kicks in and supply starts disappearing quickly, a project can move from phase 1 to phase 3 within the same day. And buyers who enter too late may unknowingly end up paying much more for the same project simply because they did not understand the phase the project was in. So now let's move on to the third key things the buyer must understand: the sales movement versus the TOP and ABSD deadline. Many buyers only focus on the project itself, but very few people will look at the developer pressure level. If a project is selling consistently every month with healthy transaction volume, developers usually have less pressure to adjust price because the demand is still strong. And the second thing we need to look at is the TOP timeline, which refers to how close the project is to the completion. Generally, once a project reaches a TOP, developers becomes more motivated to clear the remaining unsold units because holding the inventory become more costly. And finally, the most important factor, which is the ABSD deadline. For those who may not know, there's an upfront developer ABSD that's payable by developer, which is 40% of the land price. And this brings the actual cost of buying land for developers to 140% of its selling price. There is a way for developers to obtain an ABSD remission of 30% of the land price. However, in order to get the ABSD remission, they must sell all the units in the development within 5 years from the acquisition of land. So as you can imagine, right, as the 5 years ABSD developer deadline approaches, developers are likely going to be more motivated and pressurized to sell their remaining unsold units. And if there are still many unsold units remaining, developers may become more aggressive with pricing to move the units. And this is where buyers sometimes suddenly see discounts, relaunch pricing during the deadline periods. So the key takeaway here is don't just study the project, study the developer's pressure level as well. And for this point, right, let me relate to you some of the projects. So these two projects, Cascadian Reserve and Jervois Treasures, was both completed in year 2023. However, during the TOP, they still have many unsold units. So for Cascadian Reserve, right, the initial launch price was around 3,600 PSF. And you can see the sales percentage at the point of time was only about like 5% for Cascadian Reserve. And when government granted the extension of the ABSD deadline to 2024 due to the pandemic to the developers has no choice but to relaunch at a lower price to clear the remaining units. And which is what you can see, the relaunch price actually starting from 2,900 PSF onwards. And likewise for Jervois Treasures as well. The key takeaway is this: always understand the break-even price, pricing phase, and sales movement versus TOP and ABSD timeline. Because once you understand the developer strategy, you will stop guessing and start seeing how pricing really works. And of course, I'm not saying that you can't get a good value buy in phase 3. You still can if you know how to identify the right units and understand the pricing properly. So logical buyers don't just look at the project. They understand the timing, the developer pressure level, and the psychology behind the pricing. And that can make a very big difference in the price you eventually enter at. And so, if you are currently looking at a project and you are unsure whether the pricing is still safe, whether the project is already in late phase pricing, or whether there are still hidden value buy opportunities left, feel free to reach out to me and I'll be happy to help you analyze it further. So if you found this helpful, do remember to like, subscribe, and share this video with someone who is planning to buy the property. And I will see you in the next video.